Okay, so what I'm going to talk to you about is the economic outlook over the next 5 to 10 years. Likely to be quite a challenging one. What we can see, or what we may be anticipating at the moment, is that the environment is perhaps somewhat difficult. We have a lot of what I would call current concerns going on globally. We've obviously seen the deepest recession that we've seen in decades. There's quite a lot of angst about possible supply chain difficulties that are with us at the moment, and are certainly boosting inflation in many of the major countries and many other countries besides. There's also arguably a stagflation risk. There's also concerns that the central banks, the major central banks, led by the Federal Reserve, will have to act quite aggressively to stem some of these inflation threats by raising interest rates. And that could be something that causes problems in terms of the emerging market world, for instance. And all of this at a time when I think when you look across asset prices, whether it be bonds or stocks, in many countries, certainly in the advanced countries, there's concerns that those asset valuations are already quite high. So I think in a sense, there's maybe a sort of wall of worry that is out there at the moment. But I think when we look over the next 5 to 10 years, I think there's some reasons for actually more optimism than perhaps we're seeing at the moment. I think for one thing, I think that a problem in terms of global growth is that we've had very weak productivity growth amongst the labour force, and I think that could improve as a result of COVID. I think that whilst inflation is higher, it's not necessarily the case that all inflation is bad. In fact, it may even be good. And I think that also when we look at how central banks will respond and the tightening policy that may have to happen from the likes of the Federal Reserve and other central banks, I'm actually reasonably hopeful that that won't cause significant problems as far as emerging markets are concerned. So I think overall the message for me is actually more an optimistic one than a pessimistic one. When we look out 5 to 10 years, there has to be a question mark perhaps about maybe the short term, but longer term, I think there's probably more reasons for optimism than pessimism. We can see on this left-hand chart that growth has generally been coming down. The orange lines on there represent inflation per decade going back to the 1960s, and you can see that globally that growth rate has been generally tending to come down. And I think that is something that is obviously a concern for the future. Will growth continue to slow down? And I think that the second chart on the right-hand side is arguably something that perhaps provides a little bit more optimism on that front, and that's to do with productivity. I mean, I think if we ask ourselves why growth has been trending lower for many decades now, what we'd say is that there's been things going on like quite weak investment, quite weak productivity amongst certainly the big countries, like in the US and in Europe, for instance. And a lot of that is because they've outsourced their production to other countries, particularly in Asia, particularly China, and they haven't really invested sufficiently at home. What I think the pandemic will do is it will force them to invest more locally. In recent decades, productivity performance of labour and capital, which is what we call total factor productivity, that performance has generally been quite poor. But I do think that as we move on from the coronavirus crisis and the supply chain difficulties that firms are experiencing, not just in terms of goods and services, but also in terms of labour, will actually mean that the firms will invest more, and that will improve productivity. So I'm actually reasonably hopeful that this significant downtrend in productivity that we've seen is actually something that will start to turn around. We can see here that there are significant inflationary problems around at the moment. That is due to the fact that a lot of firms are experiencing supply chain difficulties. The chart on the right-hand side shows how the IMF's forecasts, for instance, have changed between their review they did back in April and the one that they just completed in October. And you can see their inflation expectations for the advanced countries have gone up quite sharply for this year, and more so than emerging market countries, and more so as well than we see for next year as well. Very simply put, what has happened with the COVID crisis is that the big countries, and the US in particular, have really overstimulated. This chart shows, again, advanced economies and emerging market countries, and shows how the IMF has adjusted its forecast as a result of what has become known during the coronavirus crisis. So starting off in 2019, the IMF thought that growth would weaken and then recover, and it didn't. But what we've started to see is, or what we have seen already, and what we continue to see in the future, is in terms of the fiscal spending, it's really the advanced countries that have pulled out all the stops. Some of the fiscal spending in advanced countries has been truly huge. The US has spent a quarter of its GDP trying to stimulate the economy, and we've not seen the same thing as far as emerging market countries are concerned, and that really is due to things like affordability. So although the revenue impacts of COVID have been similar, what's happened in terms of expenditure is we've seen far more expenditure from advanced countries than we have emerging market countries. And I think that's a large part of the reason why the inflation problem is more one in advanced countries. Again, some of these advanced countries here, we're looking at the US Federal Reserve and the European Central Bank on the left-hand side. That shows the excess liquidity in their banking systems at the moment. That's sort of the amount of liquidity that the central banks are supplying to these banking systems. It's above and beyond essentially what they need. Those excesses increased after the global financial crisis, but during coronavirus, they've really increased very dramatically. Although we've seen, a big increase in money supply growth in terms of the major economies, up until fairly recently, we hadn't seen any significant inflation, and that seems strange in some senses. But what has happened in previous years is that when money supply growth has been strong and global demand has been strong, there's always been the goods and services to supply that extra demand. And that's because, of globalization. It basically meant that as companies in the West have required increased output, if they can't do that domestically, they've been able to get extra output by outsourcing to other countries. So China in particular, rest of Asia, many other countries. So there's been a very strong supply of goods and services. And so when demand has been strong in the world, we've seen those goods and services supplied, and we haven't seen inflation rise as a result. On the other side of the coin, the inflation instead has been in asset prices, not in goods and services prices. And that's largely because the supply of those assets, whether they be equities or fixed income securities, that has been relatively static. So whilst we've seen the supply of goods and services really quite strong, we've not seen significant increase in the supply of assets, and particularly bonds. Many big central banks have been buying bonds themselves as part of their quantitative easing strategies. So I think what all this has done, if we look on the next slide, is it's created inflation. The inflation that we've seen really for quite some period of time, if you look back over the last decade, for instance, has really been in asset prices. It's not been in goods and services prices. So this shows some prices of some assets. We could have, picked out particular examples, but there's many more besides. So the history, in a sense, is that, if you look back over the last 10 years or more, is that we've had the inflation in asset prices and not in goods and services prices. And that may seem like a good thing, but I actually would argue that we probably do need to see some increase in inflation. And we are starting to see that now, which is in a sense a good thing. I know there's lots of concerns about inflation at the moment, but it is a good thing because I think that it helps the big central banks like the Federal Reserve and others get away from this situation where they are always having to push interest rates down to, near zero levels. I think we see here, again, if I start on the right-hand side, that one thing that's been lacking globally has been investment, and savings has been relatively high. And when you have quite high savings relative to investment, that tends to put downward pressure on interest rates. It means that growth is perhaps relatively muted. It means there's lots of available cash to be invested into assets like bonds or like stock. And we can see on the left-hand side, again, I've used the UK, so we've got a long history there of how long it's been that global these interest rates in this country have been coming down, but interest rates globally as well have been coming down also. So I do think that probably looking ahead, demographics will mean that the increase in and also other factors will mean that this gap between savings and investment will tend to close up. Investment will tend to rise relative to savings, and that will start to turn the interest rate cycle back up again. Obviously, policymakers do look as if they will do that from raising interest rates, but I think that bond yields as well will tend to move a little bit higher. So just the very last slide now. It's just really some of the conclusions. I'm not going to talk over this because I think my time's just about up, but it relates to some of the things that I've been talking about. Thank you.